Investors are also paying more attention to the bond market these days. Yields have been rising, and that could usher in big changes for stocks and the economy. Steve Liesman explains.
Interest rates are rising, presenting a challenge to economic growth and to the stock market. But some look at the recent rise and ask, what took so long? The Fed hiked interest rates 3 times last year, and the 10-year bond yield barely buzzed. It actually fell for much of 2017. The recent rise comes amid a report that China, a big buyer of U.S. bonds, is rethinking how much it buys. It also comes amid better growth, a rise in inflation expectations, and a coming boost to the deficit from the tax cut bill. All those factors had many thinking that rates should really be higher, not lower.
Yields are low, they are rising, they should be higher. They're nowhere near where they ought to be given the economic environment, given the global central bank pressure on keeping rates low.
The rate increases represents a modest problem for companies. Corporate bond yields have risen, so some of the tax cut benefits could be reduced by higher rates paid by corporations. Mortgage rates have also ticked up, but the gains have been modest, and rates still seem to be available around the 4% rate for would-be homeowners. The problem for the market? Do some investors think a 10-year yield of around 2.6% is a better bet than buying stocks, meaning they pull money out of equities? But this does solve a problem for the Federal Reserve. Some officials were starting to be concerned that rates in the broader economy were failing to respond while it was hiking the short-term funds rate and reducing its balance sheet. A higher long-term yield should give the Fed some comfort that its rate hikes are filtering into the economy and it's still in the game. For Nightly Business Report, I'm Steve Liesman.